There's one stock in this video where the company's own chief financial officer just walked into the open market and bought $100,000 worth of his own stock just days ago. Now, why would he do that? Well, insiders sell for all kinds of reasons, but they only buy for one reason alone. They think the stock is going higher. Now, that stock is Valmont Industries, ticker symbol VMI, and it's the first of four names that I'm watching very closely in August. And the rest of the names are diverse. One is a tiny medical device maker that keeps crushing its own earnings estimates. One is a beaten down chip stock that I think is a textbook buy the dip. And the last one, well, you'll see. Four stocks, four very different reasons. The timing looks good right now. Now, before I dig into that first stock, I should probably tell you who I am. I'm Jacob Wade. I'm a financial coach that helps high-income earners retire early. And if you do like timely stock pick videos just like this one, just hit that thumbs up button below. It lets me know to keep making more videos just like this one. Okay, now back to Valmont Industries. Now, they make the metal bones of modern infrastructure. The steel poles that hold up power lines, the towers behind your cell phone service, and the center pivot systems that irrigate much of the world's farmland. Now that sounds boring, but boring is exactly what you want when the whole country is racing to rebuild its power grid. Because honestly, that is the story right now. All this new data center and electricity demand means somebody has to build the transmission infrastructure to carry the power, and Valmont makes that steel. This is their moment. Now, let's talk about the insider buying. Again, just days ago, Valmont's own chief financial officer bought $100,000 worth of stock on the open market. And when the person that knows the numbers better than anyone else is buying with their own money, well, that tends to get my attention. But not just mine. Wall Street is on board too. The most bullish analyst covering the stock is Nathan Jones of Stifel Nicholas, who ranks in the top 2% of all analysts for stock picking performance. And as of the week that I'm recording this, they see the upside potential of more than 40% compared to current levels. And again, that bullishness isn't based on nothing. Valmont has knocked the socks off of earnings estimates in the last 2 quarters alone. Now, here is where our Zen ratings actually back it up. And a quick primer if you're new here. Now, our model runs every stock through 115 factors and boils it down to a single letter grade, A through F, just like school. And of course, an A is the best rating our system gives, and Valmont earns that A. That's the equivalent to a strong buy recommendation. That puts it in the top 5% of over 4,600 stocks that we track. Now, underneath that grade are 7 different component grades. So let's look at the standouts here. Now, growth comes in at a B. It's in the top 19%. And then it really shines in 2 different places, safety at an A, top 5%, and financials also at an A, top 5%. Now, safety in our system measures how consistent and predictable a company's earnings and cash flow are. The one thing that I would flag here is that the shares have pulled back a bit over the past month. We're looking at a 16% dip, but don't let that scare you off because that's honestly the opportunity here. Because we have a strong near-term track record, and one of the best pickers on Wall Street is pounding the table, and the CFO is buying the dip. So recent price action looks more like an opportunity than a warning. And if you couple that with a fortress balance sheet and real macro tailwind, it quickly becomes obvious why I chose this as the opener to this video. Now, a quick aside before I continue this video. If you're enjoying discovering hidden gems like the ones that I'm sharing in this video, then the best thing you can do right now is actually sign up for Wall Street Zen's live training sessions with our editor-in-chief, Steve Reitmeister. Now, it's totally free, but you do need to sign up to join. So you can do that now to join Steve this coming Monday at 7 p.m. Eastern time. Just go to wallstreetzen.com/live. All right. A steady compounder is the only real way to play this market, and our next name is far smaller and has been quietly putting up growth numbers that Wall Street keeps underestimating. And that company is Electromed, ticker symbol ELMD. Now, this is a company that makes airway clearance therapy. It's a real medical need. It is recurring, and it's the kind of niche where a small company can absolutely dominate. Now, the first thing I want to jump into here is the earnings history. Now, Electromed has 10 consecutive quarters, yes, 10 of beating EPS estimates. And feel free to pause this video and honestly look at their earnings per share year over year change column. It's impressive. And it's a sign that analysts are continuously underestimating the business. Now, I'm not going to say that this is a stock that the market has ignored. It's up more than 50% in the last 3 months and more than 100% over the past year. But here's the thing. The case for why it could go higher is actually pretty strong here. The analyst consensus lands on a strong buy recommendation, but the coverage is very thin with only 2 analysts. So the crowd has noticed the price, but Wall Street's research departments have not really fully shown up here. And there's also a catalyst dead ahead. Electromed reports earnings again in early September. If that growth keeps up, well, you know how the market is going to reward that. Now, let's actually pair that with the Zen ratings because this is where Electromed really separates itself. It earns an A grade, a strong buy recommendation. And get this, it's in the top 1% of every single stock in our entire system. Out of more than 4,600 names, this tiny medical device maker is right at the very top. And the component grades for this explain why. Because growth comes in the top 22%. Momentum is rated a B at the top 14%. Safety is also a B, but is in the top 7%. And then it really shines because sentiment earns an A grade in the top 3%, and financials is also an A grade in the top 2%. Now, the honest trade-off on a name like this is simply its size. It's really a micro cap stock, so it can be more volatile than the big blue chip stocks out there. But you have solid growth and momentum, and the smart money is moving in on sentiment and a genuinely rock solid business underneath it with an A grade in financials. So for a company this small, that combination is honestly pretty rare. And now a small quick ask before we move on. If you're getting value out of this video, just hit the subscribe button below. We publish data-driven stock analysis like this every single week. And if you don't want to miss one, just subscribe. Now, speaking of smart money moving in early, our next stock has had it piling in all year. So much so that the chart nearly went straight up and then it pulled back really hard, which is exactly why I want to talk about it. Stock 3 here is Silicone Motion, ticker symbol SIMO. And I'm going to make the case that this is one of the classic buy the dip opportunities. Now, they design controller chips inside flash storage that manage all the NAND flash memory and make it fast and reliable. Their chips end up in phones, in laptops, and increasingly in those data centers that are powering the AI boom. And as the world stores more and more data, somebody has to make the brains that manage all of that, and that is Silicone Motion. Now, the AI storage wave is their catalyst, and all this AI demand needs enormous amounts of high-speed storage, and that is lighting a fire under the entire memory space. Silicone Motion sells the picks and shovels for it. This is an opportunity. Now, over the past year, this stock has had a monster run. Honestly, it's been up 190%. So the smart money clearly showed up here, but just over the last month, shares have pulled back sharply, down more than 30%. So the question is simple. Is the story broken or is this a gift? I lean toward this is a gift, and so does Wall Street. The most bullish analyst covering the stock ranks in the top 1% of all analysts, and as of this week I'm recording, sees more than an 80% upside from here. Now, with someone with a track record like that, stays bullish even after a massive pullback, that's worth taking a very hard look. And honestly, the growth behind this company is real. Silicone Motion's revenue is forecast to grow at around 52% a year, much faster than the industry average. And the top line is expected to translate into earnings growth of roughly 83% a year. And our system gives Silicone Motion an A grade. Again, another strong buy recommendation and puts it in the top 5% of all 4,600 stocks that we track. Now, let's pop the hood and take a look at these component grades here. Now, this pick has a nice tight cluster of strength. Safety comes in at a B in the top 19%. Then momentum is a B, top 13%. And growth is also a B and in the top 9%. And closing on the standout grades, sentiment is also a B, but all the way up in the top 5%. That's 4 solid B grades stacked right on top of each other. Now, here's the honest risk. This is a semiconductor stock, and semis are cyclical and can be volatile. And that 30% drop just reminded everybody of that. But that is exactly what creates the entry point. So here's the whole case in one breath. A top 5% rated company, 2 of the most accurate analysts on Wall Street pounding the table, and shares on sale after a sharp pullback in a corner of the market that AI demand is only heating up. When a name in real motion goes on a sale like this, this is a textbook buy the dip. Now, before we get to the last stock here, one quick thing. If you like stock talk like this, videos like this, I once again remind you to check out Wall Street Zen's no-cost live training sessions. You can join our editor-in-chief, Steve Reitmeister, on Monday at 7 p.m. Eastern Time. And he doesn't just talk about what he's buying, but how he's actually finding these stocks so you can do the same in the days and weeks ahead. And he also shares his trade of the week, combining the best of Zen ratings with his 40 plus years of investing experience. So if you're liking this type of content, then I just strongly recommend just pause the video for a second, scan the QR code on the screen right here with your phone, and sign up at wallstreetzen.com/live. Again, it's free, but you got to register to be able to join. All right, stock 4 here is Omnicell, ticker symbol OMCL. Now, they build what their company calls the autonomous pharmacy. It's automation and software that helps hospitals and health systems manage medication with fewer errors and less manual labor. Now, as hospitals deal with staffing shortages and push to automate more of the pharmacy, Omnicell is one of the names selling the tools to actually do this. Now, here's why this one is interesting. On July 30th, Omnicell put up a genuinely strong quarter, adjusting earnings of 94 cents a share against Wall Street's estimates of just 47 cents. That's basically double what analysts expected. But next quarter's guidance came in a bit soft, and the market pushed on that hard. Shares fell sharply that day and have kept sliding since, down over 15% in the past month. Now, here's the twist though. While next quarter's number disappointed, Omnicell actually raised its full year earnings guidance to a range of $2.15 to $2.30 a share, which is above the roughly $1.98 a share Wall Street was expecting. So the near term outlook wobbled a bit, but the bigger picture for the full year actually got better. And that's an important distinction here, and it's exactly the kind of headline versus substance gap that can create an opportunity. And also worth noting here, a DCF model on Wall Street Zen pegs fair value on Omnicell at $60.28 a share. The stock trades at around $36.85. That's a gap of more than 60%. Now, I want to be straight with you on the analyst picture here too. Coverage is thin, just 3 analysts, but it's unanimous. All 3 rate it as a strong buy, with the average price target suggesting the stock has a 40% upside potential in the coming year from current levels, with the highest estimate calling for over 70% upside potential. And analysts aren't everything when it comes to stock, but a unanimous strong buy from every single analyst on a stock delivered in the middle of a sell-off, that says something, especially when you could back it up with data. So let's bring in the Zen ratings here. Now, Omnicell earns an A strong buy, putting it in the top 3% of more than 4,600 stocks that we track, and it's the number 1 rated stock in the entire health information service industry out of 42 different names. Now, let's look at the component grades here, because growth is a standout with an A grade in the top 2%. Though I will flag that this leans heavily on those raised forward estimates rather than a smooth trailing earning history, which has actually been a bit choppy for this company. So I want to make sure I put that caveat in there. Now, safety is at a B rating in the top 10%, values at a B rating in the top 12%. Now, again, worth noting is that this isn't a screaming bargain on paper with a PEG north of 1. So the case here rests more on the fair value gap and the guidance raise more than a rock bottom valuation. Now, the honest trade-off. Momentum and our AI grade are both sitting at a C, sitting in the bottom half of stocks that we track, which again makes sense. The stock just got hit really, really hard. So I will say that this is the highest risk name on tonight's list, and I want to be upfront about that. But a Zen rating A on fundamentals, a 60+% gap to our own fair value model, and a unanimous, if thinly covered, strong buy from Wall Street, all showing up right after a double-digit drop on a headline that kind of undersold the real story. That is the exact setup value investors are looking for. Just know that buying a dip only works if the dip, stops dipping. So this one's for viewers who can stomach a bit more chop before it hopefully settles. So there you have it, 4 stocks worth your time in August. And remember, the Zen ratings are actually updated daily. So you could pull a free rating on over 4,600 stocks yourself just by typing in your ticker symbol at wallstreetzen.com. So make sure you bookmark that website. Now, I do want to hear from you. Which of these 4 is your favorite? And is there a stock that maybe I didn't mention that you think belongs on this list? Share it with our community in the comments below. And if you're not sure what to watch next, check out the video that's popping up on your screen right now. In that one, I broke down 5 insanely cheap stocks that I'm keeping my eye on.